Hello, everyone. Welcome to another episode of the podcast. I'm your host, David Brooks, powered by Contractor Rhino, your go-to source for all your digital marketing and accounting needs for the trades. For this episode, we have some special guests with us, and I'll allow them to introduce themselves.
Good afternoon, everyone. My name is Wes Scott. I'm a partner with Frost Brown Todd, otherwise known as FBT. My partner and I, Jason Brace, cover the trades, both buy and sell side, as well as ongoing legal compliance. We've been working the space for a better part of a decade, helping founders and entrepreneurs navigate the intricacies of the legal world and help them have successful exits at the end of the rainbow. We love working the space and are thrilled to be here and want to thank David for allowing us the opportunity to join him today.
Yeah, thanks for having me.
Yeah, absolutely. Jason Brace, as Wes said, my partner. We're both partners in the M&A group at Frost Brown Todd. We work out of the Nashville office. Been doing M&A and exclusively these sort of home services deals for quite a while now. So happy to discuss with David, and thank you for having us on today.
Yeah, no, thanks guys for joining and coming on. We definitely appreciate it. So we're going to get into the M&A 101. So what are some of the key things that contractors need to consider if they're thinking about, a merger, acquisition, as part of their growth strategy?
Absolutely. I think in today's world, especially this week, David, we need to take a step back from M&A. As you have seen, the markets are in a little bit of free fall. I hate to use that word, but with the tariff wars currently raging at the moment, that is making the market awfully choppy for transactions and getting deals done, to be quite honest with you. So I think it's important to understand the backdrop of where we are at the moment. It's not 2020 or 2021. It's not funny money season anymore. PE shops and buyers are being far more strategic with their money. They're sharpening their pencil. They're looking at your books and your numbers, and they're digging in, and they're not overpaying for assets anymore. So I think it's important to understand, because one thing we run into a lot, David, is valuation dislocation. Buyers realize it's 2025, sellers think it's still 2020, and they're wondering why their buddy got paid at a 14x multiple and they're getting a 5x or 6x offer. So I think it's important to understand the macroeconomic environment we're in. Now, with that being said, there are very key factors that are out there at the moment that make it right for 2025 if we can kind of get through this choppy season to take off a little bit. I've seen numbers somewhere around $2.6 trillion of dry powder sitting on the sideline that needs to be deployed. You got private equity firms with assets that they need to exit from. So I think you'll see a robust secondary market here in a little bit. And then I guess aside from this trade war thing, at least the thought is that you have a political administration that's business friendly. And so people think that the regulatory environment, the tax environment is going to loosen up and deals are going to get done. But the big pink elephant in the room at the moment is obviously the tariff wars going on and the instability that it's causing and the uncertainty that it's causing in the market.
Mhm.
Yeah, and I think just kind of a ripple effect, starting with the tariffs and it goes through to the consumer and how that's affecting our clients' businesses and with the raising prices and how customers are going to, react to a 20% increase on a new HVAC system. People are just kind of it's more of a wait and see approach so far this first quarter than like Wes was saying back in 2020 and 2021 when it was just pedal to the metal and people were paying, anything for everything.
Mhm. Yeah, I love that current modern day insights from you both. I loved the funny money, the the money back, the COVID pandemic money is gone, right? So we're in this new reality right now, and contractors and business owners need to know how to navigate, right?
And I think it's also important to understand, I think it's important for owners who are contemplating an exit at some point in time to understand that these PE cycles will run their course, right? And so we're not going to be in a buying window all the time. Certain sectors or verticals are kind of getting more mature in the roll-up processes. Uh, Landscaping is one that's more in mature roll-up space, whereas HVAC, electrical plumbing is still pretty hot. It's important for the sellers to know, however, that PEs won't be in this world forever. And so if you're looking to do a deal, I'm not going to tell you that it's urgent that you get it done this year or anything like that, but it is also good to know in the back of your mind, this will come to an end too. I mean, nothing goes on forever. And so if you're looking to sell, now is the time to start prepping yourself for that potential sale whenever you want that to be, whether it's this year, next year, or a year or two down the road. PEs won't always be buying up trades forever. You might want to start considering how to get ready now and when to do it within this kind of 3 to 5 year window that's coming up.
Mhm. And as if I'm thinking about particularly, selling, settling down, or no, recently I've come across, businesses and people that are in the stage of I have no one to pass it down to, or the people that I do want to pass it down to, they don't want it, right? So if I'm thinking about that exit, what are some things that, as a contractor, business owner, I should be considering, guys?
Yeah, that's a great question. And I want to circle back to the kind of the legacy aspect of it as well. From a blocking and tackling perspective, David, preparation on the front end will help your purchase price on the back end. And I know our guys and gals like to be in the trucks and out on the streets and interfacing with the customers, and that's a great thing. And Service Titan does a great service for all these businesses, but there's nothing better than preparation, because when the buyer shows up and you're prepared and ready to sell, it makes the process go more smoothly. It makes the lawyer fees decrease, frankly, which I say that to my own detriment. And it also fetches you a better purchase price and a better exit at the end of the rainbow. What am I talking about? Try and make sure your financial information or financial statements are in order, relatively clean and kept to the extent that you have them prepared or looked at by a CPA. That's fantastic. That will get you ahead of the game. Your contracts, service agreements, try and have your contractual house in order. Try and inventory those if you can. Get them in some workable formatting system so that it's easier for the buyer to get through them. Also, another key point, two other key points. One is your employment documentation. They're going to go through that really, really thoroughly. So you want to have your employment documentation lined up and ready to go. Also, because branding, intellectual property assets, name is a big deal in the trades. You want to make sure that your IP is locked down if you could possibly do that before you show up for the sale, because they're going to go through your IP. They want your name, they want your market share, they want your name brand recognition. So that's another big asset that they're going to look at. To the extent that you can get those things pulled together on the front end, you will save yourself a ton of time, headache, and it will help you on your exit as far as valuation and purchase price.
That's some good information to really think about and consider. And like you said, preparation is the key, right? So you don't want to say, "Hey, I'm thinking about selling," and you just kind of roll out of bed with with the situation. That preparation is going to be vital, right?
And it's important for our sellers and founders to know, you're dealing with private equity firms. You're dealing with family offices. They're sophisticated people with sophisticated money. And so they're not going to overpay in this market anymore for assets like they used to in 20 and 2021. That season, like I mentioned a second ago, was gone. And so the pencils are sharper, the diligence is more invasive, and they're going to try and get the right price for your business. And so showing up and saying, here I am, open kimono, but yet not being prepared, typically leads to suboptimal outcomes from our perspective.
Yeah, and I think it's just important to kind of summarize, the earlier that we can get involved, normally the better. I know that people kind of think that getting an NDA or signing an LOI, they can handle it themselves. Sometimes that's the case, but if you're, this is the sale of something that you worked really hard to grow and build. Um, every document that you sign for this in this process is important. And so I think that it's normally more valuable to bring your advisors, your attorneys, if you're using an investment bank, somebody like that, your accounting firm early on in the process to make sure that everything's buttoned up and every I's dotted and T's crossed.
One thing I'd say there, David, for your audience, most people think an LOI because they'll say it's non-binding and this, that, and the other. A seller has the most leverage in a transaction before they sign the LOI. That's when you have the most purchasing power. That's when you have the most leverage. To Jason's point, no one likes hiring lawyers. We understand that. We try to be as efficient and as effective as possible. You need an attorney looking at your LOI before you sign it up, especially with a sophisticated shop like a private equity firm or a family office, because you just need it. You don't know what you're signing away. And on the backside of that LOI, even though it's non-binding, you will be held to that LOI, even though it's non-binding. They will tell you that you are retrading points and recutting the deal, which will create angst during the negotiation phase. So it is critically important, to Jason's point, to get the lawyers, to get the advisors in before you sign the LOI to make sure you get the best deal you can get.
Yeah, I love the fact that bringing you guys in early in the stage, making sure that you're aware of what is entirely covered in the deal, because a handshake and a verbal, conversation isn't binding, right? It's not on documentation. You didn't sign your name to it. I can remember one circumstance where this guy was going through selling, and he was under the understanding like, hey, these things would be like this, after the sale, and then after the sale things went that way, and he's like, oh, I would have never, and it was like, oh, you didn't read your paperwork.
Another thing I'd say there, two other things I'd say there, David. We oftentimes are brought in to help lawyers. So most of these businesses will have a lawyer, whether it's some type of lawyer, an estate planning lawyer, a litigator. They have a lawyer, and so they think that they're covered. When you show up to sell your business, you need to have an M&A lawyer by your side, because I don't draft trust and estates just like a trust and estates lawyer doesn't draft merger and acquisition documentation. Not all
Or at
lawyers in
least they
this,
shouldn't.
at least they shouldn't, and not all lawyers in the space are created equal, right? And so I don't go drafting wills. They shouldn't be drafting. If you have a lawyer that's inexperienced in buying and selling businesses, you need to go get yourself a lawyer who does this routinely. Because again, even with a lawyer, your outcome could be suboptimal. The other thing, to plug other advisors here, this is important, especially when you get into valuation discussions with private equity firms. This is a plug for the accountants out there in the world. If you're a bigger shop, this will make sense if you have a higher revenue stream. Sometimes when you come down market and your revenues aren't quite so high, it doesn't make financial sense. But oftentimes, if you're a bigger shop, it's not a bad idea to go get what we call a QV, or a quality of earnings report, from a sell side kind of accounting shop, because that will give you an independent valuation on your business. And it will show you before you ever approach the market where your weak spots are in your business. That way you can prepare for when your buyers are going to come in and fly spec those weaknesses in your business. You can be prepared to answer those weak points, and or you can remedy them before you ever hit the market. So I'd also plug sell side Q of E's if you're a bigger shop and it makes financial sense. That can save you a ton of money on your purchase price and can save you a lot of heartburn and heartache during the negotiation process.
Because the buyers are definitely going to do theirs. And if you have your own to put up against it, you can either remedy it quicker or at least have an argument against it to try and, patch something together so they're not trying to deduct your purchase price as much as they try to.
Yeah, that's really helpful. Just to have that, be aware, like you said, not all lawyers are considered equal. If I'm, dealing with estate planning, or criminal law,
Yeah.
I'm not coming in and saying, "Hey, guys, could you represent me over here?"
Yeah, and I'll tell you that it's interesting how many times we're brought in to kind of work side by side with those lawyers. When we do that, we don't come in and kick those folks out. Rather, we like working with them. They're the trusted advisor of the seller, right? And the seller has a long relationship with them. And so we actually like working with those attorneys, and we can kind of come alongside them and work with them and help facilitate the process and facilitate the paperwork while they serve as still the trusted advisor to the seller or the founder of the business. So even in those instances where you have an estate or planning lawyer, or you have a litigator who's the lead counsel, we work well in those situations to come alongside and help facilitate things. We don't kick those people out of the deal. They do serve a very valuable purpose, but it's still, the point remains, you need to have an M&A attorney involved at least, because who you're going up against, they don't give money away and they know what they're doing.
No, you want to make sure, you're coming to the table properly represented, right?
Absolutely.
Now, as a contractor, what financial operational metrics do I need to be focusing on to make my business attractive to potential buyers?
I mentioned two. We hear them routinely. Uh, Kind of, this is the main two that we as lawyers hear. I'm not going to get into like hard metrics. Recurring versus non-recurring revenue. You can light a buyer up like a Christmas tree if you can tell them I got a ton of service agreements and I've got a steady revenue stream that happens year after year after year. They love a healthy recurring versus non-recurring mix. Far more recurring sounds and feels better to the private equity shops and family offices to the buyers. And so anything as far as recurring revenue goes, that mix, we get that question all the time. The higher the recurring, the better the target. The lower the recurring gets a little tough. The other thing is concentration in customers. If you're heavily levered in one or two clients, so for instance, one or two clients of yours account for 30, 40, 50% of your revenues, that's going to be a little bit of a turnoff to a buyer because you're over levered a little bit. You don't have that diversification across your customer base. It makes them a little jittery to understand what they're buying, if that makes sense. The other thing that's kind of part and parcel of both of those is kind of the concept of new construction. Um, Jason and I are working with a fantastic business. It's an electrical business. Hypothetically, let's say 50 million in revenue, about 6 million in EBITDA. And unfortunately, they are 98% in new construction. And I can't, they've got offices across the country. They don't subcontract, it's all employee based. And we can't get a sniff because they're 98% into new construction. So it's very interesting. Those PE shops, those buyers, those family offices want recurring and they want diversification. That's what we're seeing at least.
Mm. Those are some really good things to know and to be aware of. I love how you just rolled that up and made it quite simple, right?
Yeah, and I will tell you, and that's kind of going back to getting your diligence house in order, having those service agreements ready. We're working with another business now, a commercial landscaping business. They've got 200 commercial contracts that are recurring. That's like gold to a buyer. And that is literally gold to a buyer. If you can put that in a folder in an online data room and say, I got 200 service agreements or contracts year over year, watch the purchase price go north. I mean, it's money.
Yes. That's really good. Being able to think about guys like, having those maintenance agreements, being able to have that recurring stream of revenue, have your guys going out there and upselling and providing the values. This not only help your business now continue to flourish, but later on down the line, if you're considering exiting, that is a guarantee that that's going to be there month over month.
And it's important, I think, for the sellers to understand, why does that matter to the private equity shop? Well, or to the family office. They have their own bosses and masters to answer to. They're limited partners. They're family for the family office, right? They want returns. They want stable cash flow. They don't want to lose money on their investment. And so when they see that steady recurring revenue, contractually based, diversified in nature, that's what really lights them up like a Christmas tree and fetches you a higher multiple and a higher return. And to the extent that you can prep yourself before going to market and you can lay it out all in front of them, like on at a buffet, and say, guys and gals, here it is. It's like magic. They just fight over each other.
I love that. I love that. You want them to be salivating at the bits.
You want the highest possible return.
Right.
Absolutely.
Got to take the Jerry Maguire. Show me the money, Jerry.
Absolutely. Well, you got to help yourself, right? You got to help
Right.
yourself a little bit. So,
Now, you guys have a lot of experience, right? What are some of the biggest lessons that you've learned working on the deal side in the contracting industry specifically?
Jason, you want that, or you want me to?
You can go.
So, I'll give you one horror story, David, and this kind of just puts a bow on a lot of this stuff, which is preparation, documentation, not cutting corners because your buyers are not going to be able to cut corners. They're not going to want you cutting corners. We were on the buy side on this one. Let's just say we were in West Virginia and we were buying an HVAC shop, and their employment practices were a little subpar. And by a little, I mean like a lot subpar. The day before closing, word gets out that they're going to re-verify their employment base through I-9 verification processes and procedures the day after closing. We close, everybody's high-fiving, money's moving, people are smiling, glad handing, slapping each other on the back. Let's call it Monday. Tuesday morning rolls around, turn on the lights, half the employee base is gone because they know they're about to get re-verified or verified for the first time. To me, that's a good, well, it was not fun to go through during the time, quite frankly. In fact, it was a very painful process. But it underscores the point that preparation for these types of transactions are key. That's more of a buy side horror story than a sell side horror story. But again, the point remains preparation in these things goes a long way to getting the best outcome, whichever side of the fence that you're on.
Yeah, and similar to that, so we've had a situation where you just want to be upfront when you're on the sell side with to your plan or your question earlier about succession planning. Whether you're going to stay on, whether you're not going to stay on, whether you've got family, son, daughter, whoever, grandson that's going to run the company as an employee of the new buyer, you need to make sure that both your own inner circle, your family knows, but that, the trusted group at your company that's going to be there if you're planning on exiting, everyone is aware of the situation of how this business is going to be run going forward day one after closing, because we've had deals almost collapse at the last second when somebody has decided to leave they don't want to stay on for a year or 2 years after closing. They're ready to call it, and the buyer's like, what do you mean? We need you to stay on for at least a period of time. If you don't have someone that's that you trust, that is ready, willing, and able and expecting to take over the company, then that can lead to a lot of heartache. When if you again just planned and prepared and had this all worked out to begin with, you wouldn't have to be dealing with this.
Yeah, I echo Jason's comments there. That's a great point. Forthrightness on the sales side is critical. One other thing that popped in my mind, David, sometimes we'll see founders kind of running their personal life through their business. Um, while we understand that, there's the occasional truck that gets run through the business and a few things like that, maybe a piece of real estate or two that the business uses that maybe the owner owns. Beyond that, if you're using your business kind of as your vehicle through which you're running your life, that's an immediate turn off to the buy side, I can tell you, because there's a lot to untangle. There's a lot to unwind. It's great, while you're doing it, don't get me wrong. But when it comes time to sell, if that's what your goal is to sell and exit, that's going to be a problem for you at the end of the rainbow, I can promise you. And so being honest about those things, not that people aren't honest, but sometimes people don't think about it like, oh yeah, I'm running this through the company and buy side's going to find it if you don't tell them about it on the front end. So forthrightness on the sell side is very critical, because also keep in mind, to Jason's point about succession planning, once the deal closes, you're back into reality, and more likely than not, your seller and probably some of their family members are still in the business, and you're wedded to your buyer for at least 6 months, a year, 2 years, or 3 years. You don't want to poison the well during the transaction process and then it just be hellacious for the period of time post closing that you're sticking around to help transition the business.
Yeah, you definitely want to be able to be up front. You don't want any, like they said, skeletons coming out the closet.
Yeah.
Just really good, practice overall, guys. Like, really getting your book straight, making sure that things are clean. Like you said, you may have the occasional truck or piece of real estate, but you don't want to be living life, inside of the business.
Yeah. Running your country club membership through the
Right?
organization is
Right.
not really
Yeah.
And
ideal.
I think it's also important, one other thing that we've kind of learned through, doing these deals is when you've decided and entered into an LOI with the buyer, a lot of times there's something called rollover equity, where you're going to be a part owner in the buyer going forward. Buyers do that to kind of keep you engaged in the industry. There's going to be all sorts of hooks in there to make you, if you leave within a certain period of time, it's called vest. There's a vesting schedule normally, where you don't get the full value of the equity unless you stay during for that time. You need to do, and that's why, always having someone on your side to help vet these buyers. You need to do your own diligence. You need to look at them. Um, do you really want 20% of the purchase price to get rolled over into a company without you knowing anything about it? Yes, there might be a big New York private equity firm, but do you really know what their operations look like? And they're not gonna give you everything, but at least asking some questions to getting some comfort that a fifth of your purchase price isn't just gonna go to some random LLC that rolls up, similar companies. You kind of want to know, how that business is run.
Mhm.
Yeah, that's a great point, Jason. We like to call that reverse diligence. That rollover equity is an investment by our sellers into the platform company. So the sellers are making an investment in the buyer in that instance. And Jason's 100% right. You need to ask some questions. You need to understand what you're getting into. You need to understand the financial viability of the entity that you're rolling over into going forward. That also leads to the point at the top of the call here, David. Um, we're seeing more structure in this environment and the deals. What does that mean? Because it's a little choppy, because there's dislocation between valuation expectations between buyers and sellers. Earnouts are more common. Rollover is more common. It's not, here's your $20 million and walk away and, whistle Dixie all the way home. We're seeing a lot more of these tethers that keep our sellers tied to the business after the closing and keep their skin in the game based off performance metrics. To Jason's point about rollover equity, make sure you understand the entity you're getting involved in. With respect to earnouts, if you see an earnout in your deal, you need to know with crystal clarity how that earnout works, how it's being calculated, and it needs to be reduced to writing before you sign the purchase agreement. And you need to understand who's in charge of calculating that number, even once you get the calculation set, because there's a lot of fuzzy math or different inputs that can go into that earnout once you've closed and once you've sold your business.
Mhm.
Very critical.
Yeah. And what sort of priority that earnout gets paid out, whether, if they pay off their debt first, or, there's all sorts of different orders of priority where a company can play around with when you get your earnout. Even if you hit your metric,
Mhm.
they could still hold it, for certain reasons. So it's always good to have, like as Wes said, a crystal clear contractor on that.
Mhm. You want to be able to, like you said, have it crystal clear because it's nothing worse than thinking you about to cash in that lottery ticket and they tell you, wait, 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 wait. Did you read the fine print?
Right.
And at
Yeah,
that,
you might have hit your gross target, but
Right.
read the bottom line.
and at that point, you're out of control, right? You don't have, like, well, you can fight about it, but you're out of control. And you really got to know on the front end.
Yeah, you're going to be fighting somebody with deeper pockets than you.
Mhm.
Um, so
Yeah, so due diligence, be aware, have a trusted advisor, right? Can help guide you through navigating the process.
Absolutely.
absolutely.
Now, one of wrapping up here, as if I'm a contractor and I'm on the fence about pursuing this opportunity, what advice would you give me?
My advice would be you've got to do what's best for you, your family, and what's true to yourself. Um, I talked about a window where there's a world where PE will move on from the trades or won't buy up the trade so much because they're so rolled up at some point down the road. But whenever you're making your decision to do what you want to do, you got to do what's best for you. You got to do what's best for your situation and your family. Guys like Jason and I, we're here to help. We're here to help you talk through those issues. Is this deal right for you? Is that deal better for you? Frankly, we've coached people to not do deals because the deal structure is so bad or so onerous that we've talked our clients out of selling and waiting until the next season when the market kind of comes back around to them and they fetch better returns. I think trust, honesty, and just keeping your goals first is the main advice I would give to a seller. Everybody's goals and dreams and needs and wants are different, right? And so figure out what those are for you and your business and your family, stick to them, and make the process align with your goals and your vision, not your goals and your vision becoming malleable to the process and chasing an exit and a rainbow and a check. Because then your priorities are out of whack. And then you start compromising and then you start giving things away and points away that you shouldn't give away. So to me, it's about what's your goals, what's your vision, what do you want for yourself and your family?
Yeah, I agree with that wholeheartedly, but also to add on to it, once you establish those, I think it is important to hire advisors to advocate those goals and your plan for you, because we have seen and have been brought in on the back end instances where somebody has tried to do it themselves and not brought in advisors, and they're trying to negotiate, pull all the, let's say 200 contracts. They don't have to go. They're having to sneak around because they don't want anyone to know about it. So they're having to, work late, find the contracts. It starts dragging on your business because that's not what you're accustomed to doing, is negotiating this kind of stuff, pulling together diligence, looking at your financials, dealing with calls, reviewing a 50, 100-page purchase agreement. I think that while it might cost you some money, I think it's well worth your time, your sanity, and to maintain your business the way that the buyer is expecting to get it. Um, I think it's very important to hire somebody that, or multiple, specialties like attorneys, bankers, accountants to really help you through this process, because it is, this is a very large deal. Other than, you know, I mean, some people have multiple businesses, but this might be your one chance to save your family's legacy. And why would you try to, skimp on it?
What about on that? Spend a little money on the front end will save you a ton of money and heartache on the back end.
Mm, I love that. Valuable advice. Well, guys, thanks so much. Amazing insights and information. We definitely appreciate it. We know the audience is going to find so much value in this. If someone wanted to reach out, where can they find you guys at?
Yeah, so Jason and I work for the law firm of Frost, Brown, Todd. We are a national law firm. We got about 700 lawyers. Jason and I sit in Nashville, Tennessee. Both of our profiles are online. My email address is wscott, SCOTT, at fbtlaw.com.
And mine's jbrace at fbtlaw.com.
Excellent. We appreciate it, guys. Thanks so much.
Thank you, David. This has
Yeah,
been
thank
awesome.
you.
Welcome. Everyone, thanks so much for listening and tuning in to this episode. Make sure you tune into the next one. Until next time.